Are you tired of missing the perfect trade entries? In this video, I'm breaking down exactly how to build a winning entry model, step by step. We'll go over the core concepts, key confluences, and how reversals actually form so you can catch moves before they happen. By the end, you'll know which entry model fits your style and how to use it to level up your trading results. Let's get straight into it. Before we get into the strategy itself, let's talk about something that can completely change your results: kill zones. If you're day trading, meaning you're working with anything below the 1-hour chart, these kill zone windows are where the best setups usually happen. They're basically the most active times in the market when volume and volatility spike. Personally, I love trading the New York AM session, especially when I'm trading indices. That's typically between 8:30 and 11 a.m. But if you prefer the London session, your prime window is around 2 to 5 a.m. Now, your time frame choice really comes down to who you are as a trader. If you like fast moves and quick feedback, you'll probably enjoy the lower time frames. If you're more patient and like to wait for clean, high probability setups, higher time frames will feel a lot smoother. Personally, I sit somewhere in the middle. I trade the 5-minute chart. It lines up nicely with the daily structure and gives me that perfect balance between speed and clarity. At the end of the day, there's no one-size-fits-all approach. Test different sessions, experiment with timeframes, and find what fits your rhythm as a trader. Alright, now let's dive into the core ideas behind entry models. Quick tip before we start: don't try to swallow every concept at once. That's one of the biggest mistakes I see. Pick one idea, master it, then move to the next. First up, the fair value gap, or FVG. I made a full deep dive on this. I'll pin a link in the top right if you want a visual walkthrough. In simple terms, an FVG is a 3-candle imbalance. It shows up when the third candle's high doesn't overlap the first candle's low, or when the third candle's low doesn't overlap the first candle's high. That empty space is an imbalance the market often comes back to fill. Mark that zone as a point of interest. Price frequently returns to react there, giving you a potential area to watch for entries or confirmations. Next up, let's talk about inversions. An inversion happens when a fair value gap gets fully filled and then flips its role, meaning it turns into support if price moves higher, or resistance if price moves lower. It's basically the market saying, this zone still matters, but from the opposite side. Now on to my personal favorite, the order block. This forms when price reaches into a key level or point of interest and prints a series of up-close candles in a bearish setup, or down-close candles in a bullish one. Once price breaks below or above that zone, it often defines the next direction. For example, if price breaks below an up-close candle, that area can flip into resistance, signaling a potential move lower. If price breaks above a down-close candle, that zone can turn into support, often where the next leg higher begins. Finally, let's cover the breaker block. It's similar to an order block, but with a small twist in the market structure. You'll typically see a high, a low, a higher high, and then a lower low. In a bearish scenario, mark the down-close candles between that high and low. That area often acts as resistance. For a bullish breaker, it's the opposite. You'll see a low, a high, a lower low, and then a higher high. Mark the up-close candles in that sequence. That zone becomes potential support for price to push higher. Alright, let's move on to the next concept, the dealing range theory, or simply DRT. This is where we take an impulse leg, also known as a displacement leg, and draw a Fibonacci from the high to the low of that move. Now, the key area I focus on is the 25 level. That's usually where I look for the market to form a lower high before continuing in the main trend direction. Think of it as the sweet spot where the market tends to reset before pushing further. Now that we've covered the core concepts, I want you to take a moment and think about which one stands out most to you. Maybe it's the fair value gap, or perhaps the order block makes more sense for your style. Whatever it is, keep that concept in mind, because from here on, we'll start stacking confluences to build even stronger entry models. So, let's talk about those confluences. You can pair your chosen concept with tools like premium and discount zones, or use OT level. For example, If you spot a fair value gap inside a discount zone, that often signals a potential low forming. On the other hand, if you find an order block sitting in a premium zone, that could hint at a potential high forming. The idea is to combine multiple layers of logic: price structure, imbalance, and premium/discount context, so your entries become more precise and higher probability. Now, my personal favorite type of confluence is something called SMT, which stands for Smart Money Technique. Basically, it's about comparing two correlated assets and noticing when they don't move the same way. For instance, let's say one asset makes a higher low, while the other one makes a lower low at the same time. That difference in structure can be an early clue that a reversal might be forming. Speaking of reversals, let's go over the order in which they usually form. As we go through this list, keep the concept you picked earlier in mind. That'll help you understand how it fits into the bigger picture. So, most reversals tend to follow this pattern. 1. Sweep liquidity. This is where the market sweeps a major low, or high, to take out liquidity. If there's SMT divergence, you might not see a purge first. 3. Inversion. After that sweep, if price closes above a fair value gap from that last leg down, that's your inversion, a shift in how price is delivered. 4. Change of character and order block formation. Then, you'll notice a series of down-close candles, in a bullish setup, get broken to the upside. That's a signal that delivery has shifted. 5. Fair value gap or breaker block. These are usually the final confirmations that the reversal is valid. Now remember, the further down this list you go, the more confirmation you have that a true reversal has formed. But the trade-off is, you'll also be entering later in the move. Personally, I like to trade continuations. That means I'd rather catch the move earlier, even with less confirmation, because that's where the better risk to reward usually is. So to sum it up, almost every reversal starts with a liquidity sweep or SMT, then comes an inversion, a shift in delivery, and finally a breaker block or fair value gap confirming the new direction. The earlier you spot these signs, the better your entry, but always balance confirmation with timing. For instance, let's say one asset makes a higher low, while the other one makes a lower low at the same time. That difference in structure can be an early clue that a reversal might be forming. Alright, let's go through a few top-down examples so you can see how this approach actually works in real market conditions. We're looking at the daily chart, and you can clearly see an uptrend. Now look to the left and ask yourself, where is price most likely to go next? Toward this low or up to that high? In my view, since the overall trend is bullish, and price has already grabbed the liquidity sitting below those lows, we're now sitting on an FVG. On top of that, we have a breaker block, and according to the DRT, price is around the 25 level and sitting in the discount zone, which means there's a good chance for another move up, possibly taking out that high. To me, it's pretty clear that price is more likely to reach the high, so we'll keep a bullish bias going into the next day. Now, let's drop down to lower time frames and see what's really happening under the hood. Looking at the daily structure, what do we notice? During the Asian session, the market made a few failed attempts to break out, creating equal highs and lows, basically forming a range with liquidity sitting on both sides. So, if we're bullish for the day, we can expect price to run the equal lows first, sweeping liquidity below, before we look for signs of a reversal. As we let the candles play out, that's exactly what happens. Price takes the lows. That's our liquidity sweep, or step 1 of the reversal process. Now, as you can see, there was an FVG here that got filled, and then we form an IFVG. That's step 2, the reversal. If you look even closer, you'll spot another FVG, a shift in market structure, that's step 3, and a breaker block forming right in the same zone. Once you map it all out, you can see how all these elements line up perfectly, acting as confluence for a strong move upward. Now, where do we expect it to go next? Ideally, we'd like to see price run toward the Asian session highs and maybe keep climbing on the daily chart. Let's do a quick recap. We had a bullish bias, identified our daily setup, and then followed the reversal sequence, starting with the liquidity sweep, then the reversal, market structure shift, breaker block, and finally the fair value gap. But again, like I've said many times, you don't need to focus on all of these at once. That's where most traders get lost. Instead, just pick one or two concepts that make sense to you. Personally, I mostly focus on market structure shifts, because that fits my trading style best. But I know traders who only trade reversals, or only look for breaker blocks, and that's totally fine. The key is figuring out what clicks for you, what feels most natural when you're reading price. Alright, let's take a look at another example, this time from the daily chart. Here, price has reached an important BPR, balanced price range, area that lines up with a weekly zone, and I'm expecting a reaction and possibly a reversal from this level. So, let's follow price action and see if it gives us the right conditions for an entry. Now, as you can see, price swept a low, then closed back above that range, and started to move lower again. That's our first step done. Next, we look for step 2, the reversal, which we can see hasn't happened yet. Then comes step 3, the shift in market structure, and right after that, we spot a breaker block and another fair value gap. If we mark both of those, you'll notice how they overlap perfectly, adding strong confluence to our bullish setup. So now, I'm expecting price to retrace back into that fair value gap or breaker, respect the order block, and then continue higher. And as it plays out, that's exactly what happens. Price pulls back to the breaker, holds structure beautifully, then pushes up and eventually takes out the target highs. Alright, so yeah, I hope this video was helpful for you. If you've got any questions, or there's something specific you'd like me to break down in another video, just drop a comment below. I read all of them. And if you enjoyed this lesson and picked up something new, don't forget to hit the like button, subscribe, and turn on notifications so you don't miss future uploads. Thanks so much for watching, and as always, trade smart, stay patient, and I'll see you in the next video.